Hello, my name is Matthew Granger and this is the FCTO Weekly Review and Outlook for July the 2nd, 2012. Expectations on last week's EU summit were pretty low, but the responses were overwhelmingly positive. Risk markets were given a strong boost, with the Dow jumping from an intra-week low of 12,450 to close at 12,880. European equities were also strong, with the FTSE jumping from an intra-week low of 5,435 to close at 5,571, while the DAX also rebounded from an intra-week low of 6,096.9 to close at 6,416. Commodity markets were also strong, with the CRB index rebounding to close at 284.19 after dipping to 268.78 in midweek. The dollar index, on the other hand, dived to as low as 81.43 before closing at 81.62, comparing to intra-week highs of 82.88. The strong momentum in risk markets suggests that more rallying lies ahead in the near term, and we'll now possibly see the Dow revisiting this year's high in Q3. Based on that development, dollar and yen would likely remain pressured. Probably due to the lack of expectations over the EU summit, the measures agreed by the 17-nation leaders surprisingly lifted market sentiment. The European Commission proposed to create a single supervisory mechanism with the European Central Bank involved, allowing the Spanish banking system to be financed through the European Financial Stability Facility for the moment, which will later be replaced by the European Stability Mechanism without application of the seniority status and by using the existing instruments to stabilise markets for member states. EU leaders agreed on a growth pact worth €120 billion, including a €10 billion capital boost for the European Investment Bank. Herman Van Rompuy stated that the growth pact is a sign of their unrelenting commitment, bringing together all concrete measures that they will swiftly take. Concerning the €100 billion bailout programme for Spain, the leaders concluded that financial assistance will be provided by the European Financial Stability Facility until the European Stability Mechanism becomes available. More importantly, there will be no party gaining seniority status, indicating the same status enjoyed by fund and private investors. The developments of the EU summit overshadowed other negative developments in the Eurozone. Shortly after Spain's formal request for bailing out its banking sector, Moody's reduced long-term debt and deposit ratings for 28 Spanish banks and 2 issuer ratings. That included a cut to Banco Santander's long-term rating to Baa2 from A3 and Banco Bilbao's to Baa3 from A3. Both are Spain's largest lenders and are placed not far from junk level. Overall, over a dozen of Spanish banks were downgraded to junk status, and Moody's had downgraded 6 banks by 4 notches and 10 by 3. According to the ratings agencies, these banks have a link to Spain's creditworthiness, which has deteriorated and will affect the credit profile for Spanish banks. Also, Cyprus has asked for financial assistance from the EU and the IMF to save its banks, making it the 5th country in the bloc that needed bailout. Yet the amount and terms will still need some negotiation in coming days. It's expected that the required fund will range from 5 to 10 billion euros compared with the 100 billion euros required by Spain. The European Central Bank allotted 26.3 billion to banks in the region in its 3-month refinancing operation. 50 banks bid for the funding compared to 33 in the last operation in May. That's a slightly higher amount compared to the 25.13 billion in the 3 months funds maturing later this week, and around 1 billion of net rise in liquidity would be resulted. Meanwhile, there are speculations that since the bank won't start the bond buying program, the central bank might opt for a rate cut next week. In the US, Fed officials continue to voice diverging opinions about additional easing. Atlanta Fed Lockhart said that he didn't think the conditions have developed that require them to bring out bigger guns quite yet. He'd prefer to be a bit patient and look at incoming data. Asked what consolidations would warrant additional stimulus, Lockhart said dramatically slower growth and a threat of deflation would prompt him into consideration. He said the Operation Twist extension announced earlier this month is the maintenance of a policy that was in place that keeps pressure on longer-term rates. St. Louis Fed Bullard said that current monetary policy remains ultra-easy and is likely appropriately calibrated to the current situation. He said that to get to the third round of quantitative easing, you would have to get a sharp drop-off in economic activity in the US or a clear threat of deflation, and he doesn't see either one right now. He warned that an ultra-easy policy could reignite a 1970s type experience globally if pursued too aggressively. On the other hand, Chicago Fed Evans continued to be dovish and urged the Fed to do more accommodation than what was adopted under the twist. Evans said that the labour market situation had been completely unsatisfactory. He warned if there were any substantial downside shocks hit over the next 6 to 12 months, the economy was not in the best place. He'd support more asset purchases to provide additional accommodation. New York Fed Dudley said that economic recovery had been disappointing and momentum had slowed in the last few months. Dudley noted that employment slowed considerably of late and the unemployment rate remains elevated. He would look into the material data on a number of dimensions in the coming week and adjust his stance. Bank of England officials addressed Parliament's Treasury Committee, with Governor King saying that the Monetary Policy Committee is united on the need for a very loose monetary policy, but views divergent on precisely how loose it should be. He noted that the bank could do more on asset purchases and there is no immediate limit or constraint on that. But King would prefer to see how the situation plays out first. Meanwhile, saying he's pessimistic and concerned about the Eurozone. In Japan, the lower house of Parliament passed the bill to double the consumption tax in 3 years by a vote of 363 to 96. The bill will then be voted by the upper house to become law, and it's very likely to be approved. The consumption tax hike was a means to ease the fiscal deficit of the Japanese economy. However, the impact is expected to be small. While the government anticipates it would help soothe the fiscal problems, opposition parties believe this would weaken demand for domestic goods, further hurting the nation's economy. Some analysts viewed that the hike would weaken the outlook of the Japanese yen. On the political front, opponents of the tax hike may submit a no-confidence motion regarding the bill. The worst-case scenario would be resignation of the Noda cabinet or dissolution of the lower house and elections. And lastly, in China, in order to ease the liquidity problem, the People's Bank of China conducted a 14-day reverse repurchase of operations worth 125 billion over the past 2 days. This was the third round of reverse repo operations following a similar money injection in January and May. The move raises a chance of other cuts in the forthcoming days. And that's it. For more detailed analysis and daily updates on all the news affecting the Forex market, join us throughout the week at www.forexcurrencytradingonline.co.uk. That's www.forexcurrencytradingonline.co.uk.